I need to be perfectly clear about the severity of the position we find ourselves in right now. Forget the daily noise, disregard the cheerleaders on cable news, and turn off the algorithmic feed that promises perpetual growth. What is happening beneath the surface of the indices, what is being willfully obscured by institutional players and central banks, is a fundamental and irreversible shift in the structure of capital preservation. We are standing at the precipice of a seismic event that will rearrange the winners and losers of the next decade, and for those who hold positions anchored in the fading paradigm, the consequences will be devastating. I've spent decades observing these cycles, the euphoria, the denial, and the eventual brutal reckoning. And when a figure like Eric Sprott, a man who built his fortune on the bedrock principle of sound money and the reality of market mechanics, issues a warning this stark, you need to stop and listen. His message is not a mere correction forecast. It is an urgent declaration. The time for selling, for jettisoning the dead weight of the current portfolio structure, is not coming. It is here. Now. The foundation of the entire global financial ecosystem is resting on a fiction, a multi-trillion-dollar illusion of solvency maintained solely through unprecedented levels of debt creation and the suppression of the true cost of capital. For years, the mantra was simple: borrow cheap, leverage high, and buy paper assets that only appreciate because the currency itself is being debased. That era is over. It has been violently replaced by an environment where money is no longer free, where debt demands payment at punishing new rates, and where the malinvestments of the last 15 years are finally being exposed to the harsh light of reality. The core conflict we face is simple. Interest rates have risen faster and higher than the financial system was engineered to withstand. When the Federal Reserve and other major central banks embarked on their aggressive hiking cycle, the immediate effect was supposed to be the dampening of consumer inflation. It did that to an extent, but the far more significant, delayed and lethal consequence has been the slow-motion destruction of asset valuations that were predicated on a zero-interest rate world. Think of the economy as a complex machine built exclusively using extremely cheap plastic parts. When you introduce extreme heat, in this case high interest rates, those parts don't just stop working, they melt, deform, and cause the entire structure to seize up. This seizure is what we are witnessing right now. The indices might look resilient on the surface, shielded by the concentrated power of a few mega-cap tech giants. But look deeper. Look at the breadth of the market. Look at the balance sheets of the mid-tier corporations, the regional banks, and the real-world assets that fuel commerce. They are cracking under the pressure. The yield curve has been screaming recession for months, and historically, its warnings are almost perfectly predictive. This inversion is not a theoretical anomaly. It is the market telling you that short-term costs are punitive, and the long-term outlook is fundamentally pessimistic. Sprott's analysis pinpoints this precise moment of inflection. He argues that capital is moving rapidly into preservation mode, exiting sectors that are structurally vulnerable to sustained high rates and debt rollover risk. We are not just talking about companies that miss earnings targets. We are talking about entire sectors that relied on continuous, cheap refinancing to survive. These are the zombie companies and zombie assets that only existed because capital was essentially free. Now that the tide of liquidity has receded, we are seeing precisely who was swimming naked. The danger is hiding in plain sight, and it affects not one, not two, but four massive pillars of the modern economy. The complacency permeating the retail investing landscape is astonishing, considering the scale of the debt wall hitting maturity in the next 18 to 36 months. We are heading into an environment where companies and asset holders who thought they secured 5% debt for 10 years are suddenly forced to refinance at 8, 9, or even 10%. That mathematical differential instantly vaporizes equity, turning previously viable businesses and income-producing assets into cash-burning liabilities. So let's cut through the noise and address the immediate danger. Eric Sprott is urging capital flight from four distinct areas. These are the sectors that, due to their specific structural leverage, reliance on future growth, or susceptibility to interest rate shock, are collapsing internally, even if external indices haven't fully priced in the decay yet. The first sector that Sprott singles out for immediate and urgent liquidation is commercial real estate, CRE. This is, quite possibly, the most colossal ticking time bomb currently embedded within the global financial system, especially within North America. The dynamics here are disastrously simple. CRE relies almost entirely on constant financing and robust occupancy. Both legs of this stool have been aggressively sawed off. Let's dissect the mechanics. Commercial real estate, unlike residential property, operates on a much shorter refinancing cycle. Massive swathes of office buildings, retail parks, and industrial spaces were acquired or developed between 2015 and 2021 using ultra-low interest rate debt, often secured via floating rates or short-term fixed rates, maturing between 5 and 7 years. That debt wall is hitting now, and it is immense. Hundreds of billions of dollars set to roll over. The problem is the spread bound. A building appraised in 2020 on the assumption of a 3% capitalization rate, valued highly because of cheap financing, is now being reappraised using a 6 or 7% cap rate required by today's cost of capital. This simple change in the financing rate can instantly reduce the underlying property valuation by 30 to 50%. Suddenly, the loan-to-value ratio is upside down. The property is underwater, and the collateral is insufficient to cover the outstanding principal. Compounding this refinancing nightmare is the dramatic shift in occupancy and demand, particularly in the office segment. The permanent establishment of hybrid or remote work models has hollowed out city centers. Vacancy rates in major metropolitan areas are at historic highs, sometimes reaching 25 to 30%. Less occupancy means less rental income. Less rental income means lower net operating income, NOI. Lower NOI means the property is fundamentally incapable of servicing the new higher debt load. We are entering a phase of forced sales and defaults because the mathematics simply do not work. Lenders, many of which are regional and smaller banks that we will discuss shortly, cannot afford to extend these loans because the collateral has evaporated. They are facing a brutal choice: seize the non-performing asset and incur massive losses, or extend and pretend, only to delay the inevitable. Sprott's warning is clear. Capital allocated to CRE, whether through REITs, real estate investment trusts, direct equity, or even exposure through structured finance, is highly contaminated. The losses are baked in, and they are enormous. This slow-motion collapse in CRE isn't just a cyclical downturn. It is a structural repricing of the modern workspace and urban configuration that will take years, possibly a decade, to clear out. And it is only the first major fault line. The second sector requiring immediate exit, according to Sprott's urgent thesis, is one that is inextricably linked to the first: regional banks and specific financial institutions. This segment is the transmission mechanism for the poison spreading from the commercial real estate market, but its problems extend far beyond just bad CRE loans. The regional banking crisis that briefly flared in the spring of last year with Silicon Valley Bank and others was not an isolated incident caused by poor risk management at a few institutions. It was the canary in the coal mine, signaling deep structural rot stemming from the Federal Reserve's own policies. When interest rates were held near zero for so long, these regional banks were essentially forced to chase yield. They loaded their balance sheets with long-dated fixed-income assets, like treasury bonds and mortgage-backed securities, MBSs, that offered minimal yield but were deemed safe. The moment rates skyrocketed, the market value of those long-dated bonds plummeted. This created massive unrealized losses on the banking balance sheets, a financial vulnerability that required deposits to remain stable to mask the problem. But now the crisis is twofold. First, the unrealized losses on those securities portfolios are still there. If banks have to sell those assets to meet withdrawal demands, those losses become realized, potentially triggering insolvency. Second, and more immediately pressing, is their direct exposure to the aforementioned commercial real estate crisis. Regional banks are disproportionately responsible for lending to mid-sized property developers and owners. Estimates suggest that banks with less than $100 billion in assets hold nearly 70 to 80% of the nation's total outstanding CRE loans. As those CRE loans mature in default, the banks that hold the paper will be forced to take losses. This leads to a vicious cycle of tightening lending standards, reduced credit availability, and the further contraction of economic activity in the regions they serve. The system is highly interconnected. A collapse in regional bank lending starves smaller businesses of credit, slows construction, and reinforces the economic malaise. Sprott's argument here emphasizes the systemic vulnerability. These institutions, unlike the too-big-to-fail behemoths, lack the diverse funding sources and governmental backstops to truly weather a simultaneous collapse in their fixed-income portfolios and their major loan portfolios, CRE. Their stock valuations might seem cheap on paper, but they are a classic value trap. They are cheap because the market is gradually pricing in massive future write-downs and potential liquidity events that will necessitate drastic, painful measures. The move out of these two initial sectors, CRE and the vulnerable financials, is purely defensive. It is about de-risking against the sectors that are most exposed to the twin pressures of high rates and decelerating economic activity. We are witnessing the ultimate payback for the years of reckless financial engineering built on the assumption that the cost of money would remain perpetually suppressed. This collapse is structural, not cyclical, and it requires radical repositioning. But the warning doesn't stop there. The capital destruction will not be limited to these highly leveraged, tangible asset classes. Sprott warns that the third and fourth collapsing sectors are based on fundamentally flawed growth narratives and overextended speculative capital, representing a different kind of imminent danger that we must address with equal urgency. We are talking about highly speculative growth, sectors where the PE ratios are still discounting decades of perfect execution, and where profitability is a secondary concern to market narrative and momentum. The shifting economic winds have made these positions untenable, forcing a massive, painful rotation. To truly understand the scope of the required maneuver, we need to delve into these remaining two sectors, the ones representing the most euphoric excesses of the bubble era, and identify the strategic safe harbors that Eric Sprott himself is advocating for. This is where the preservation of capital transforms into the multiplication of wealth, but only if you execute the exit strategy immediately and precisely. The current financial environment is not forgiving. It is hostile, competitive, and designed to strip wealth from the complacent and the unprepared. If you are currently holding significant exposure to commercial real estate or the regional banking indices, you are holding positions designed for an economy that no longer exists. The window for a clean exit is closing rapidly as more institutions begin to price in the inevitable defaults and revaluations. This is the time for decisiveness. This is the moment to prioritize capital preservation over the hope of a miraculous recovery in deeply impaired assets. We must prepare not just for recession, but for a fundamental deleveraging that will reset asset values to their true, non-leveraged, high-interest rate equilibrium. We have established the first two pillars of collapse, but the remaining two are perhaps even more seductive to the average investor, shrouded in the promise of unending technological momentum. We must now turn our attention to the structural weaknesses in the hyper-growth narrative and the consumer-facing industries most sensitive to the impending liquidity crisis, before finally outlining the defensive and offensive positioning required to navigate this epochal shift. The next steps are critical, defining the difference between merely surviving this contraction and positioning oneself for the enormous opportunities that always emerge from the ashes of structural collapses. The question is no longer if the dam will break, but when the structural integrity gives way under the weight of unprecedented leverage and monetary distortion. In Part 1, we established the foundational cracks identified by Eric Sprott and his team. The irreversible systemic fragility beginning in the financial sector, particularly regional banking tied deeply to commercial real estate, and the evaporation of speculative oxygen from the overhyped, non-profitable segments of the technology complex. But those, my friends, were merely the warning shots fired at the periphery of the economy. If you sold those positions, you secured your flanks. Now we must address the core, the engine room, because the remaining two sectors Sprott warns are collapsing are the very pillars that define the American consumer and the global supply chain itself. This is where the real devastation lies, and this is why immediate divestment is not merely prudent, it is an absolute necessity for capital preservation. Look closely at the macroeconomic landscape. The Federal Reserve is trapped in a paradox of its own making. On one hand, core inflation remains persistently elevated, a direct consequence of years of money printing and supply chain fragmentation. On the other hand, the lagging effects of the fastest rate hike cycle in 4 decades are finally slamming into corporate balance sheets and, crucially, the household budget. We are watching the slow-motion collision between sticky inflation and an impending hard recession. There is no soft landing when the system is structurally impaired by $34 trillion in national debt, and a consumer whose only remaining resilience is credit card debt accruing at 21%. This leads us directly to the third sector Sprott places squarely in the crosshairs: consumer discretionary. For the last 3 years, the narrative has been that the consumer is strong, relying on pandemic-era excess savings. That narrative is now utterly bankrupt. We have reached the point of exhaustion. Those savings are gone. The residual demand we see is highly artificial, fueled by the aggressive drawdown of revolving credit. Auto loan delinquencies are spiking to levels unseen since 2009. Credit card default rates are accelerating faster than any central banker predicted. This isn't just a cyclical slowdown. This is a fundamental impairment of the retail ecosystem. Think about the implications for consumer discretionary companies. They rely on high volume and predictable spending patterns to cover massive fixed costs: rent for hundreds of locations, global logistics contracts, and inventory financing. When the consumer pulls back, they don't just reduce sales by 5%. They experience a collapse in margin because they lose the necessary volume throughput to cover their operational leverage. This results in 2 immediate and compounding crises: the inventory crisis and the employment crisis. Firstly, the inventory crisis. Companies that overbought in 2021 and 2022, anticipating sustained post-pandemic demand, are now sitting on mountains of outdated or unwanted goods. Liquidation sales are insufficient to clear the glut without destroying capital. This inventory has to be financed, tying up lines of credit that are becoming exponentially more expensive to roll over. This leads to a vicious cycle. Margin calls increase, cash flow vanishes, and the inevitable wave of bankruptcies begins, starting with the mid-tier retailers and cascading upward through the logistics providers, the warehousing companies, and the commercial property owners who lease them space. We are seeing a complete deterioration of the high street and the large format retail experience that defined the last 30 years. Sprott's warning here is simple. If the consumer is tapped out, the apparatus built to serve that consumer is obsolete and massively over-leveraged, guaranteeing systemic collapse in this sector. And secondly, the employment crisis. As sales volumes drop and financing costs soar, companies have no choice but to reduce headcount drastically, turning cyclical unemployment into structural unemployment. This further reduces consumer demand, accelerating the collapse in a self-reinforcing deflationary spiral within this specific sector, even while services inflation continues to plague the broader economy. The discretionary sector is a textbook example of a fragile structure waiting for the final push, and that push is the high cost of debt meeting the exhausted consumer balance sheet. Sell the consumer-facing stocks. They are walking dead, awaiting the final accounting. Now, let us pivot from the consumer crisis to the crisis of foundational input, the element that touches every single link in the supply chain, from the smallest manufacturer in Asia to the largest distribution center in the U.S. Energy. This might sound counterintuitive. Why would Eric Sprott, known for anticipating commodity bull markets, warn about a collapse in the energy sector? The key lies not in the underlying commodity price, which is volatile and often manipulated, but in the structural insolvency and political risk associated with the major energy producers and explorers, particularly in the traditional fossil fuel space. This is the fourth sector that Sprott insists must be exited immediately, and for reasons far more complex than simple oil price volatility. The energy sector is caught between 2 impossible forces: regulatory imperative and massive underinvestment. On one side, we have political and ESG pressures demanding a rapid transition away from hydrocarbons, resulting in significant capital constriction and hesitancy toward long-term, multi-billion-dollar capex projects required to maintain output. On the other side, the global economy still overwhelmingly runs on oil and gas, and depletion rates require constant, massive capital injections just to keep production flat. The collapse Sprott predicts is twofold. First, the collapse of confidence in their long-term solvency among investors outside of the immediate commodity price spike. The regulatory risk makes these long-duration investments poisonous. Second, and more immediately devastating, is the impending demand shock that a global hard recession will bring. When the consumer discretionary sector, Sector 3, collapses, global trade and logistics slow to a crawl. Manufacturing shutters, freight traffic plummets. This is when the price of crude oil and natural gas, which were perhaps temporarily inflated by geopolitical tensions or artificial supply constraints, will crater in the face of evaporating industrial demand. Companies that relied on high prices to service their operational debt, especially those in the heavily leveraged shale plays, will face immediate solvency challenges. We are talking about margin calls on hedged positions, covenant breaches, and a liquidity freeze that takes out the highly indebted independent producers. This means that while the underlying commodity itself may be fundamentally sound in the very long term due to underinvestment, the equity that represents the production companies is an extraordinarily dangerous place to park capital right now. Sprott isn't warning against energy itself. He is warning against the systemic fragility of the companies that extract it, which are currently priced for perfection but structurally prepared for insolvency the moment the global economy catches a serious cold. Sell the energy stocks. Avoid the complex geopolitical risk overlaid onto massive balance sheet fragility. We have now definitively addressed the four collapsing sectors: commercial real estate or regional banks, speculative technology hype, consumer discretionary, and energy producers. If these four massive pillars of the modern economy are actively collapsing, and the data suggests they are, then the inevitable outcome is a widespread reduction in confidence, a severe credit contraction, and a flight of capital away from anything tethered to the traditional debt-based financial system. This brings us to the climax, the defining moment of Eric Sprott's decades-long investment philosophy, and the ultimate reason why he has issued this urgent "sell now" directive. When the financial system begins to digest the scale of these four implosions, where does the truly safe money go? Where is the capital allocated that cannot be digitally debased, legislatively requisitioned, or economically bankrupted? The answer, the ultimate safe harbor, is tangible, unencumbered, non-fiat, non-cyclical wealth, precious metals. This is the grande finale of the Sprott thesis. He argues that the collapse of these four sectors is merely the necessary precursor to the explosion in gold and silver prices. The collapse forces the central bank's hands. As unemployment spikes and deflation grips key parts of the economy, the Fed's only possible move, the move they must make to prevent a full-blown depression, is the most aggressive monetary easing and money-printing operation ever conceived. They will pivot. They will cut rates back to zero, and they will restart quantitative easing with a ferocity that will make the 2008 and 2020 responses look like minor interventions. This is the fiat debasement cycle reaching its terminal phase. Gold and silver thrive when confidence in the currency evaporates, and nothing evaporates confidence faster than printing trillions of dollars to plug structural holes created by collapsing real estate, bankrupt retailers, and failing banks. Sprott's insight is focused on the vast disparity between the paper price of these metals and the true physical reality. Consider this. Global debt is surging, yet the amount of accessible physical gold and silver supply is shrinking, constrained by years of underinvestment in mining and complex metallurgical challenges. Central banks globally, the sophisticated actors who understand the game of monetary reserves better than anyone, are buying gold at near-record rates, essentially signaling that they too are preparing for a world where the US dollar no longer commands universal trust. They are converting digital, depreciating assets into tangible historical wealth. For the individual investor seeking shelter from the four collapsing sectors, Sprott advocates aggressively moving into physical gold and silver, and crucially, into the highest quality, most financially disciplined mining companies, The ones poised to see exponential earnings growth when the metals inevitably reprice due to hyperliquidity and monetary inflation. This is not a modest adjustment of 5 or 10%. Sprott believes the repricing event is going to be violent. When the realization dawns that the $34 trillion debt problem is being solved by simply printing more currency, the capital that fled the collapsing sectors, trillions of dollars, will seek the ultimate safety and liquidity of gold and silver. Sprott stresses physical delivery. Do not rely solely on paper derivatives or ETFs that may or may not be backed by the underlying metal in a crisis. We are preparing for systemic failure, and in a systemic failure, the claim on an asset is worth significantly less than the asset itself. This is the difference between surviving and thriving. The ultimate conclusion is stark but clear. The 4 sectors detailed, CRE financials, speculative tech, consumer discretionary, and energy producers, represent the high-risk, debt-fueled structure of the prior cycle. Their collapse is not avoidable. It is inevitable and already underway. Selling these now provides the necessary dry powder. This capital must be redeployed into the only asset class that benefits universally from collapsing confidence and extreme monetary expansion: gold, silver, and the elite mining companies that produce them. This is the pivot point. This is the moment in financial history when preserving your principal means actively rejecting the conventional credit-dependent investment thesis and embracing the tangible reality of sound money. Eric Sprott is telling you to take action before the masses realize the gravity of the 4 structural collapses. Do not delay. Do not wait for the confirmation of the masses, for by then, the price of true safety will be inaccessible. Execute the sell order on the collapsing sectors immediately and reposition that capital into tangible assets, physical gold, physical silver, and the carefully selected high-margin producers that offer incredible leverage to this coming monetary reset. Your financial future depends not on weathering the storm in collapsing paper assets, but on using this critical window to transition into the enduring strength of tangible wealth. The time for caution is over. The time for decisive action is now.